All right, everybody, we're going to take a look at a couple of markets and analyze the turning points, see how they occurred. For this, I'm going to use basically a bar chart and zoom in on the bar chart using a footprint, but not getting all too, into all the order flow details, just enough to put on a trade and understand what's going on. All right. I don't need all this. Alright, so what we want to do, first of all, today you had the market pull back, and on the NASDAQ it was really much more clearer than on the ES. And on the ES, there was buying activity, was right here. You could tell, right? The biggest in 18 up waves. The biggest volume in 18 up waves. So 2.1 times average up volume, biggest in 18 up waves, right there. So, it's 18 up waves, right? That's significant. 2.1 times average up volume. And that's it. So that's your sign of strength or change of behavior or change of character, whatever you call it. That's smart money, that's demand. Alright, then it goes up. Now, surprisingly, it went up in a way that usually doesn't go up, in that it's making just higher high, higher low, higher high, higher low, high low, high low, high low, higher high, higher low, higher high, higher low, higher high, until this point, which was all the way till the end of the day. And at this point is where you had your SP. What is SP? Is spring. Alright? Now, this is it's a type of spring. It's a type of spring. There are different types of springs. This is just the one I like. Alright, so you can see that this was the first spring. So typically the chances of it's working is very high. And it just made a higher high because it's the end of the day. So that's all you're gonna get. Alright. Now the thing is, what we want to do is study the dynamics of the spring to understand what it is and how it occurs. It's very important because first of all, you have to understand that this is in an uptrend. Alright, if it's in a downtrend, it's a lower low. So this is in an uptrend, and the background has a rally. So it's testing. It's testing a demand area. Alright, it's not in a downtrend where you have a lower low. It's basically an ABC correction here. Alright, it's a type of ABC, and you have rallies in the background. See the blue rallies with strength, all of that. So it's not, it's a corrective pattern. That's what it is. So this is different than, in a big trading range, and then they do the shakeout. Although springs are actually a type of shakeout. It's just that this is, the same thing as the ABC. But it's a spring nonetheless. Alright, how we're going to take out the stops and a support level, minor support level, and then close above it with strength, with demand. Alright, so we're going to examine this. So the first thing is, I have to explain. First thing is that this is an excellent trading signal. You can trade multiple markets with it. It's really, why it's great is because it's low risk. It's a low risk. Springs and upthrusts are low risk because you trade them at the danger point. They're called danger point. I can't even draw this. But anyway, the point is that they're close to the danger point. Why is it the danger point? Because if it breaks through, it's going to break the support level and fall through. Potentially either going to the next support level or, just turning trend. So it's what's important to know about this, let me see if I can change this. Alright, so what I wanted to explain was when you have a trend, right, it's very important to understand what's going on at these spots. These spots are critical if you buy pullbacks, and what you're looking for is for demand to be greater than supply. So you're looking for demand to get greater than supply. And that'll basically show accumulation activity. Alright, how do we do that? Volume. That's really it. It's just buying activity. So as the market goes down, volume should start increasing as the market goes down. And as it pulls back, I'm not talking about breaking supports here, you know, at the rally low. I'm talking about corrective pullbacks. The pullback volume increases. That means that demand's coming in. Alright? So what we're looking for is that accumulation or reaccumulation. So I'm going to examine this leg right here as we spring up. So examine the leg as we spring up. Alright. So you see it's going down, 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 right? Going down, down. Okay, and the other thing I want to explain, these numbers here, they tell me that this is the biggest volume in X many bars. It could be 10 bars, 5 bars, 20 bars. So you see that when it pulls back, right, this bar is the biggest volume in 13 red bars. Alright, and it continues to go lower. This is the biggest in 2, this is the biggest in 3, this is the biggest in 5. Okay, now I'm getting interested, especially because it's taking out this low. It's taking out this low. Alright, so I want to see if they break and fall through or if something else happens. So in this area, we're examining the attempt to break. This is the biggest in 5. This is the biggest in 6 red bars. And look at the one that's biggest in 21 red bars. This little shit is the biggest volume in 21 red bars. This little bar is the biggest in 21 red bars. Look at the distance. Look at the increase in volume and look at the progress. Look at the amount of money and what do you get for it. Look at this. And look at this. This is the input. What's the output? Nothing. So that is why when we break this, we are observing the volume and the output, watching it. Because the increase in volume allows big player to come in and take the other side. Alright, the increase in volume is like the concept of a climax we call panic selling. This is panic stop, or it's not panic, it stopped running, similar to panic selling. Alright, so we're seeing the increase in volume, increase in output, except here. Here we have a situation. That little bar is a situation. That little bar is a situation. You cannot see it on a price chart and think anything of it. It's totally obscure. You don't know anything about it. If you're looking at a price chart, you don't realize how important this bar is. If you're looking at a price chart, this little bar in the middle is totally meaningless. It's just a little bar, and you might think, oh, it's maybe an inside bar or I don't know, some whatever it is. But in examining its input to output in terms of volume and price, this bar has the biggest volume in the entire leg. In the entire down leg, this bar has the biggest volume. It's almost like the concept of a selling climax relative to a swing. And what happens after it? Do you have follow through? Does the market go down? No, it returns up. It goes back up within the range above this low. Why? Because this bar is demand entering. This bar is demand. This is supply, I should say meets, right? So let me update this. So supply meets demand right there. Supply encounters demand, and supply meets demand right here. So supply meets demand right here. And what do you have after that? Demand. More demand. Supply meets demand, and demand pushes price up. So this would be your ease of movement, which confirms, what is this? You said on the pullbacks you have reaccumulation. That's reaccumulation. That bar is reaccumulation. That's your effort. You want to call it effort? Fine. Call it effort, reaccumulation, whatever, buying, demand. All the terms mean the same thing. And what it means is buying pressure is going to go up. So you see this and that gives you an understanding of what's going on. Meaning this is demand entering and pushing price up. And that's about it. Even above here, this was supply entering right up there, which caused the down move, right? Like even here, this is supply entering. This is the high, demand attempts, supply enters. So sometimes it's pretty obvious, and I think on breaks it's very obvious, right? Because it doesn't have follow through. Instead, it has a reversal. What is the result of the high volume? Is it further downward movement? No, it's strong upward movement. So supply meets demand, and demand overpowers supply here, causing the ease of movement and putting the market in this state of having one more up leg. All right, let's take maybe there's some other examples as well. Let's go to crude. Yeah, I mean, it's pretty obvious here too. So let's say so we'll take a look at this crack, this break, and maybe this one. So this low gets taken here. What happens as a result? So that low, you see the supply come in. That's the supply entering, right? But the problem is it can't follow through. So your supply meets demand here. We know this because you don't have to wait for the outcome. You know this because of the increase in volume. You know this because of the increase in volume on the attempt to break. Now the question is, does it follow through? No, it reverses right here. Right here. And it gives you a little move. And you know what else is funny? At this high, right? At this high, if you look across, we examine what happens when this high gets tapped. This bar has the most amount of volume in 16 bars. So we examine the crack here, and we see that this demand encounters supply. Demand meets supply right there. Why? Because you just look at the level and look at the heavy volume, and you know that stops are getting hit or break, limit orders are being executed and all of that. The whole point is, what's it doing at the levels, at highs and lows? And we see that the number is the biggest in the entire swing. So this is the most amount of volume in 16 bars. And look at the output. There's less output here than, let's say, about 2 bars before, where you see the bigger one, the bigger bar has less volume, and this one has more volume and is relatively small. All right, so what happens afterwards? That's what we're looking for. What is the first? The first indication is the range. There's something wrong. All right, now here we had good range, so this had a chance to fall through to the downside and break and do all of that, but instead they took it up and sweep. This is more effective than this because it's clearer, because there is effort, because there's more volume than most of the prior bars, and significantly lesser than almost all of these group of bars. It's the second smallest. I don't know. It's smaller than this one, and it's smaller than this one, and it's smaller than that. But it has more volume than all three. So you can see the size of the bar shrinks. The size of the bar is telling you something's not right. The progress from prior bar close to this close is also not right. So you could tell from the open to the close, or the prior bar close to this bar close, that all that volume, what did you get for it? Nothing. Problem. And then the bar after is your ease of movement. So that is demand meets supply, and that is your ease of movement. And this is the end of day, so I can't really read it. All these numbers are going to act crazy if you go end of day. So this is your break and test. Let's see where the hell this is. . right? So you have your rally, it pulls back. Again, if you're looking at price, you're not going to see any of this. You see that here is the most amount of red volume in 24 bars on the pullback. It's followed by the most amount of volume in 51 green bars. So clearly, what you can say about this is supply is meeting demand, and you have your ease of movement. Even the size of the bar tells you it's ease of movement. It's the biggest in 7 bars. Ease of movement. In general, I'm only going to look for this in the support and resistance levels. Why? Because you want to focus on the edges. On the edges. So this is another decent example where you have this high and this high, right? So you just wait. And you see that the demand, it taps supply right here on this bar. That's the most amount of volume in 16 bars. All right, now there's one crazy bar that's in here, right? But maybe, you know, based on the time or something like that, the volumes increase, especially in the open of the session and the close of the session. But we're going to make it easy and just look at the volume at the levels. And what we see is you know, these two highs are the resistance points. It attempts to break 1 and 2, and what happens? Bingo! You have a lot of volume, and after that you have your ease of movement. Now there is one other indicator I needed to add, the effort indicator, but I'm not sure if it's going to work as good on this type of chart as it does on the PNF tape reading chart. But anyway, let's keep on going. Can't read this. It's not a spring. This is a spring. This is a upthrust of these highs. Let's move on to the next market. Did I do the E? I didn't do the ES. Good. So we can examine this as well. All right, so let's examine this. This goes down. Goes down. At this level, this little shit bar has the most. You see, it's even small. It's the most amount of volume in 14 green bars. 14 green bars. That's more than the whole swing. All right. So what do we say? We say the first thing you say is you just wait for the crack of the lows and the highs. All right. So just wait for the crack of the lows and the highs. And does it have high volume? Yes, it does. That means supply is meeting demand. Right, so you don't really need to worry about the outcomes yet. Just did supply meet demand, or did demand meet supply on a crack of the highs and lows? And the answer is yes. Okay, now what? Now we look for ease of movement, and there she is. Supply meets demand on this green bar, which has the biggest volume in 14 green bars, and demand overpowers supply because of the ease of movement. Even at this high right here, first we look for the crack with heavy volumes to say yes, demand has met supply. That's the most amount of volume on this in the swing, biggest in 11 bars. And yeah, this time it's not a small, like a smaller bar. Ideally, if this is the best situation when the ranges shrink and there's there's not a lot of progress in the closes. So there's shortening of thrust or small range or lack of progress in the closes. These are three price based behaviors of weakness. We have none of that here. All we see is that the volumes expanded. So just based on that, we're taking a look at it and see and are able to make the judgment that demand is meeting supply. Now what's interesting is there's no follow through. Because there's no follow through, we look for ease of movement, which occurs here. Interestingly enough, right after that, you actually had a lot of supply show its hand. Alright? Sometimes you see ease of movement right away, sometimes supply will show its hand. There's more volume in this red bar than there is in this green bar. So that means that demand is meeting supply, literally. Look at this, 11 and 12. Most amount of volume in 11 bars, most amount of volume in 12 red bars. Done. There is another situation here. As we examine this, we see these lows get taken, right? These lows get taken. So what happens? Supply meets demand. You can only make that judgment that supply is meeting demand. You cannot, you can't really say anything other than that. Because you don't know yet. Is it going to follow through and break down? Maybe. So we say from these lows, supply is meeting demand, and interestingly enough, it closes green. But when we're looking for ease of movement, do we get it? Yes, we do. So supply meets demand, and bang, ease of movement. What happens? You can see what happens. I don't see anything here. All right, let's move to another market. I'll do this again with let's go to nat gas. All right, back. Oh my gosh, this is one that's used. You can use any of these lows. So this one I'm not fond of, but let's go to one that's clear, so it's you can see what's going on. So this is a low, and the numbers increase. So supply is meeting demand. here, and here. We see supply meets demand because as the lows get taken, the volumes increase, right? Now demand came in here and here, but we want the high to be taken by a green bar. And where does that happen? There. I want to see either a very strong bullish bar or the high of the supply meets demand bar taken out. You can see very clearly. This is the low, volumes increase, supply meets demand. No question. Whether it's a breakout or breakdown, who cares? The volumes increase. Supply meets demand. After that, do we have follow through? No, we don't. Does the high get taken? Not yet. What happens? Supply meets more demand. Does the high get taken? Not yet. Next bar, yes. Bing. All right. See, this is a case where supply meets demand and overwhelms it. You see this low. This is your real breakdown. Where you see supply meets demand. Demand is weak, 0, 0, nothing, and so it continues. Too weak. I can't really judge this. It's just zeros and end of the day. So remember, end of the day and the beginning of the day it's not really advisable to try to read because it's just too fast and nothing that makes sense. All right, let's go to some other examples, maybe. What time is this? Overnight. Not interested. This is garbage. See, this is how you know not to take it. Do you see any volumes come out? No. So there's no accumulation. So this is why it's so important not to just look at price. You have to see the volumes. I trade this. All right. We'll take a look at this. Oh, I think I traded this. Anyway, so you had a couple of examples here. All right, let me see which one. Okay. It's a minor upthrust, but we'll look for the spring. It's very clear. You can see that this low gets taken. So when the numbers increase, supply, because someone's always taking the other side, so supply has to meet demand, right? And now we have demand stepping in. So this supply of 5 is meeting the demand of 7. Supply is meeting demand literally. It's next to each other, bar to bar. But I wanna see a strong green bar, preferably take out the high. You don't get that until this bar. That's your ease of movement. In fact, that's the biggest green bar in 6 green bars. So that's why it works. So supply met demand. Demand overtook supply here. And we'll do this again. At this lows, you had supply meet demand right here. It's not a high number, but, and there's a crazy number over here. But this is where supply meets demand. You see, there's no progress in the close. Remember, from a price perspective, there's three things. 1, progress in the close. 2, the range of the bar. And the third would probably, the third one is shortening of the thrust. Anyway, so there is no thrust here. There's no progress in the close, and volume expands. So all we can say is it met some type of supply met demand, and then after that you have your ease of movement. Why is this ease of movement? Typically looking for two things. 1, expansion, strong bull bar, or it should at least take out the high, preferably with a close above the high. So no other, okay, maybe here, remember, why do we not take it? There's no volume. The supply, where's the demand? See this low is 0. Where's the supply? Where's the supply meets demand? It's not there. So there's something not quite right. There's very little, and that because it's little, it just creates a little bounce. This one is actually, this one's okay. This high, I prefer it to be an upthrust, but it's not an upthrust. It's a retest perfect double top. Perfect double top. Alright? What can we say? Because of the expansion, we can say demand met supply in this bar. And then we can say there was ease of movement in this bar, offering the short. How? Demand meets supply here. Supply overcomes demand here. This is a crazy one because of the time of day. This is another example. This high is met with that higher high. So we'll say that demand meets supply. Right? What happens after that? Ease of movement. Right there. Demand met supply. Why? It's biggest in 38 bars. What happened after that? Bang, down she goes. Even this one, you can tell. You see where it breaks, numbers increase. What does that mean? Supply meets demand. Does it have fall through? No. What happens? Takes out the high on increasing the biggest volume in 6 green bars. That's where we started at. So, what's the point of all this? The point of all this is to analyze to learn how to analyze a chart, and specifically the dynamics of springs and upthrusts, and knowing what to look for. Springs and upthrusts, we started with the premise that there's accumulation and distribution done, and in order to clearly see that, we need to see supply meeting demand and demand overpowering supply, and vice versa, to go and move the market. So where do we see that here? When the market breaks these lows, you see the supply increase, and then demand come here. So we can say the supply is meeting demand, and finally you have your demand overpowering supply, which is your ease of movement. So this is how the market is turning from a low to a rotation back up. All right, that's all I got. So what you can do, is just look at the volumes on the spring. So all you got to do is look at two things. One is the volumes on the springs and upthrust, along with the range of the reversal bar. That'll also help, and whether it takes out the high. So analyzing these two together, you'll know how to identify springs, real springs. All right, take care, bye. And upthrusts.